But let's think here about value, whether this slide downward is just a correction, bringing multiples back to what these companies are actually worth, or whether we're seeing a bursting bubble reminiscent, dare we say it, the dot-com era of 20 years ago. Let's bring in Aswath Damordaran, professor of finance at NYU Stern School of Business, and Dan Morgan, senior vice president and portfolio manager at Synovus Trust. Welcome to both of you. Aswath, so we talk about valuation, really just how much is a stock worth? How much should you pay for it? Apple behaves differently in this market from a Netflix, different from an Intel or a Snowflake. How far from the typical range of how stocks have been valued have we gotten, and are we back to normal yet for the most part?
I think the big difference between 2001 and now is tech now is the biggest segment of the market by far. And within tech, you have a huge variation in companies. I mean, just last week, I broke down tech companies by age, by corporate age. It's amazing how much of a difference there is between the youngest tech companies and the oldest tech companies. In fact, I think some of the oldest tech companies are among the best value investments in the market. The youngest tech companies, which have negative earnings, negative cash flows, very dependent on external capital, are getting slaughtered in this market.
But isn't there anything in the middle? Dan, let me throw this one at you. Is there anything in the middle, kind of, right, that's maybe younger but has a solid business, its stock is way down, and so the value it might actually be there?
I think you take the Netflix and the Ubers in the world. They're in the middle ground, but both have significant problems with their business models. In the good times, we don't notice. Netflix is always what I called a hamster wheel model, which is you create more content, you sign up on users, you get a higher market price, and you go out and create even more content. And the question, even in the good times, was how do you get off this hamster wheel? We're discovering the weakest links in the business models at some of these mid-level companies. And I think we're going to find out which of these companies are capable of fixing the limits in their business models and which ones are going to get shaken out.
Okay, Dan Morgan, to you then, how do you look for value in this market? Is it just a matter of looking at the big older companies and finding safety there, or is it worth holding your nose and taking a flyer on some of these younger growth names that have been beaten down?
Well, John, we in the Synovus Trust Company, we tend to focus on the more mature models. We didn't really engage in some of these more aggressive IPOs that came out since 2020 after the pandemic. So we pretty much focus on companies that have been around a much longer period of time. I think it'd be kind of tough at this point, John, to kind of take a risk on some of those stocks. We've had a tremendous devaluation as we've seen inflation start to move up. There's an inverse relationship between inflation and PE ratios. If we go back and look at times where we've had very, very high inflation, like back in the 70s, we had very low multiples. So those stocks really get hurt, as you were mentioning before, because they have unproven business models. So we would tend to focus on probably the more mature companies and trying to find value in them, opposed to dipping our foot in the water, taking a big risk on a stock that might have just gone public in the last 2 years. A tech name that does have an unproven model.
What about a Snowflake, for example, right? It's been growing. It's been more than doubling year over year. It has, strong customer base, typical trajectory for what tends to be a successful software company. But boy, that stock is way down. At what point, if not now, do you look at a company like that and say, maybe it's worth buying?
Right, John. Snowflake's a tough name just because I don't believe they have earnings. Correct me if I'm wrong, unless they're adjusted. And in terms of your value, would be simply based on a price to sales or the growth of the sales and their future ability in their market. Again, I hate to disappoint you, but we tend to focus more on the mature names. Snowflake would be something that we would wait to eventually become profitable before we started to really take a hard look at it. We own other names in that space, like an Adobe or something of that nature in the software area. But Snowflake is something that, because it isn't profitable, we tend to veer away from.
Now, I ask because they are reporting results in just a few hours. Not personally disappointed. Of course, I don't personally invest in individual stocks, but trying to get the viewers, as always, the best intelligence. Aswath, Dan, thank you.